We caught up with the joint MD and CEO of JSW Steel, Jayant Acharya, to talk about their second quarter results, which was impacted due to the pressure of lower steel prices.
Quarter two was a challenging quarter. As you said rightly, the international prices were weaker, and that resulted into domestic prices also reflecting the same. We were able to manage that through offsetting through costs, and that, by and large, gave us a similar EBITDA to what we had for the quarter one as well. The Indian operations did quite well. I think the Indian operation, the production was the highest ever, the domestic sales was the highest ever. The EBITDA was actually a little better for Indian operations than the quarter one. Our international overseas subsidiaries had their challenges with respect to the pricing environment, as well as a shutdown which was there in Ohio for a maintenance. But I think on the exceptional item which you asked, this is with relation to a mine in Orissa, which is the Jajang iron ore mine, which we decided to surrender because it was becoming uneconomical to use this low grade which is left in the mine. And that is why we decided to surrender that. And we have taken a provision to that extent in our books in quarter one.
Got it. And what will be the implications of the closure of the said iron ore mine?
It will be positive. Basically, because this particular mine was of a very low grade, which was not economically viable to use, because the specifications did not result in a cost advantage. So therefore, we decided to surrender it. We have other mines which are able to provide a better quality, which is required by us. So therefore, surrendering this mine won't have a negative impact. Actually, it will have a positive impact because the quality of the alternate material will be better.
EBITDA and realizations per ton have also taken a hit. What's the outlook on pricing for the rest of the financial year?
So, in China basically has been a key player in the international market, as you're aware. China exports have increased by about 20% plus in the first 9 months. However, the China stimulus announcement has been positive. That has been taken well by the market at large. Not only the stock market, but I think the commodity markets also reacted positively to it. Steel prices also reflected an improvement. We saw a similar improvement in India. The prices in the month of October went up after bottoming out in September. H2 being a seasonally stronger half, we expect that the pricing environment will be better. We see from a cost positioning point of view, our coking coal costs are going down. Last quarter, our coking coal cost went down by about $27. We expect in this coming quarter also the coking coal cost to go down by $20 to $25. It's through one is the international prices went down, and the other one is that we changed our blend and sourcing to make it more sustainable. So therefore, we are benefiting on the cost. We expect slightly improved prices. We have increased the prices by about 1,000 to 2,000 rupees in the month of October on different products. So we expect that to sustain on a seasonally strong quarters ahead.
And if you could give maybe a range that you see EBITDA per ton stabilizing at?
I would not like to comment on an EBITDA per ton or on EBITDA spread specifically, but let me put it this way that we have new capacities which are coming on stream. JVML blast furnace has been commissioned. The SMS is under commissioning. We have seen the BAPSL capacities getting completed. So in the second half, our volumes will be much higher. Therefore, our guidance of sales and production, whatever we have given, we stand by that. So increase in volume will result in increase in absolute EBITDA, and that will improve the overall profitability of the company. It will be difficult to comment on the spread at this point of time.
Let's now talk about demand. Now, in terms of customer-wise segment demand, what's working? Has there been any impact in the recent slowdown in the auto segment?
Well, as a matter of fact, our sales to automotive went up. We actually had, in H1, we had the highest ever automotive sales. There are different reasons for it. But so, first of all, just to reflect back on the demand last half, the India demand first grew by 13.5%, which was a very good growth, in spite of the fact that we had elections and a monsoon disruption in between. The automotive sector has seen some impact with respect to the growth, as you rightly said. But because of various approvals, because the auto typically takes time to approve a particular steel product. So therefore, from a penetration point of view, I think we had a good sale. We see infrastructure capex picking up in the second half of this year. That will drive steel demand. We also see a better monsoon resulting into better rural recovery. We have already seen two-wheelers going up, appliances going up. The third piece is the energy transition. We are seeing more demand coming in from solar and wind, which we are ourselves also adding in capacity to turn to more of green, let's say, and reduce our emissions. So the demand on the energy sector is also going up. Overall, I think we are quite positive for the second half. Increased volume from our side will help meet the demand, and I think that will improve the general EBITDA for the company as well.
Export sales is also something that was significantly impacted with a 43% drop. Could you maybe give us some understanding into the current difference between Chinese and Indian steel prices, and how could this shape up going forward?
So in quarter two, yes, the international prices, specifically from China and FTA countries, zero duty impacted us. We have seen an increase in international prices after the China stimulus. So I think we are seeing a situation where probably international prices from China and domestic prices are near parity. I think we will see some moderation in the winter months from China. Their production has already moderated in the month of August and September to about 77, 78 million tons. Hopefully that will result into lower exports out of China, but that's a hope. We'll see how time goes. But I think on a pricing environment, because most of the steel makers have narrow margins, my sense is that the pricing has bottomed out and will improve. We have seen that in India as well, where prices in October have improved. And that should be positive in a seasonally strong quarters, which we see ahead.
The company's also lowered its FY25 capex to around 16,000 to 70,000 crores. Why was this revision made, and why has the BF3 expansion been rescheduled to next year?
Yeah, so specifically on the capex, we had planned about 20,000 crores. You're right, we have recalibrated a bit to 16 to 17,000 crores, primarily on account of two reasons. One, the slurry pipeline project we are transferring to JSW Infra at arm's length pricing, and that would give us a reduced capex because that would be now spent by the infrastructure company. And the BF3, where we have postponed the modification, that also releases some capex in this financial year. That's why these are two main reasons why the capex has been recalibrated. None of the critical projects have been impacted. However, if I look at why the BF3 we had to reschedule, that is primarily because the JBML blast furnace got delayed and the commissioning has just happened. The ramp up will happen in Q4. So after the ramp up is stabilized, we will take the shutdown of the BF3 after April. So that's the reason for the change, nothing else. And that has also caused recalibration of the capex.
Got it, Mr. Acharya. Q2 also saw a 6% quarter-on-quarter increase in debt to over 85,000 crore rupees. Why was this uptick there, and what levels could debt remain in FY25 end?
So debt uptick, as I said, we have spent about 7,850 crores of capex. We had a tough H1 from international perspective. So one was the capex. The second one was investments in a coking coal mine, which we have done. So we have done an investment in Illawarra coking coal mine. We have spent $120 million on that to have a 20% look-through interest. And the third reason was that working capital basically has increased, primarily on account of some inventories which have got increased on lower exports. Also, new inventories for the upcoming capacities which are coming on stream. As we go into the year, we will be releasing some of these working capital. Increase in EBITDA from additional volumes will help us deleverage as well. So those should improve the debt positioning, and we expect the debt in absolute terms to go down as we end the financial year.
The company has also recently announced the acquisition of the ThyssenKrupp Electric Steel India Company. How will this be funded, and what was the rationale behind this venture?
So ThyssenKrupp Electrical Steel is a joint venture between JSW Steel and JFE. Both together have acquired the asset. This is a CRGO asset, which is primarily a product which is imported in the country. This goes for transformers and generators, where the country's demand is really going up fast. Overall, actually, the world demand is going up fast. And we are integrating this to make for the first time, right from iron ore to CRGO in India. We have also acquired the technology in this process, and that's a very good positive for the technology has been acquired by JSW Steel. So we will now have the technology for CRGO in India. This product is a high advanced technology product, which very few in the world have. This will provide us much higher EBITDA numbers in terms of because the price of the product is far better. So therefore, the rationale is to meet the India demand, to replace import, increasing demand with better profitability.